Nvidia Corp is down 3% to $141.69 a share. The reason for this is they released their latest earnings, and despite these being, I would say, excellent, the stock is down. But this does happen to Nvidia basically every time. So what we're going to be doing is talking through these earnings and going through the latest numbers, then seeing if it is a buy or a sell using these updated earnings in my automated stock valuation spreadsheet, looking at the discounted free cash flow model, comparable company model, Venn Graham formula for intrinsic value, and we'll be seeing if it is a buy or a sell. So let's have a look at these numbers. We have the 3 months ended October 23 versus 24. We also have the 9 months ended for those time periods as well. Revenue has doubled from last year, 18.1 billion to 35.1. That is a crazy growth. And if we look at the 9 months ended, even more so, 38.8 billion up to 91 billion. Next, we'll be looking at net income. This is profit, 9.2 billion up to 19.3, so almost 10 billion more in profit since last year. And the 9 months, 17.4 to 50.7. Net income per share, that is up obviously 37 to 79, and obviously in the 9 months, 71 to $2.07. They have been buying back their shares. The numbers has decreased 24.6 to 24.5. They're rewarding shareholders. And next we will look at the free cash flow. Now they have actually calculated this for me nicely here. There you go. Thank you, Nvidia. This again is the, let's just make sure the things, 3 months ended. Oh, we have a multiple here. 3 months ended October, July, and October of the current year. And then the 9 months ended as well. Let me scroll down. Here we are. So we'll look at these numbers. Went from 7 billion to 13.4 to 16.7 in the most recent quarter. This is operating cash flow is up, as we can see here, and capex is up very slightly. No, down actually slightly, as you can see here. So 16.7. Prior 9 months, 47.6. That is up to from 16.5, so 45 billion in free cash flow in the last 9 months. Excellent to see. So let's go to my automated stock valuation spreadsheet. We will put in the ticker Nvidia, and we will add in these latest numbers, obviously, because they are not included, as these numbers are hot off the press. So I do have some manual overrides, but we can see here it does load up some stuff quickly. 3.5 or 3.6 trillion market cap, largest company in the S&P 500. PE 68, quite high. Market average is around about 30. Earnings per share $2.13 and a beta of 1.65, meaning it's more volatile than the market. And analysts do say it is buy with $161 a share. Do pay a dividend, 0.3%, 4 cents a share. Billion dividend, incredibly safe, less than 1% of their net income and free cash flow ratio. So we do have the numbers now. Trailing 12 months for revenue was 113 billion, but we do have the most recent number here, which was 35.082. So the revenue now is 126 billion. Net income for the trailing 12 months was 63.1 billion. And the latest revenue number is 19.3, so that is up to 70. Shares outstanding we don't do, and free cash flow, it was about 16 billion. I'm just doing this on my other sheet, you cannot see it. 16.7 billion, or 78, 16,787, and that is up to 62 billion free cash flow, so increasing. And then look at these prior numbers, we'll have a look at these now. So revenue, all-time highs, 162 billion. Doubled the prior year, which doubled the year before that. So they're growing at exponential growth, as you can see here. Are they generating the same profit from that? Yeah, yes, actually more so. 70 billion compared to 30 and 4.3. Free cash flow up 62 billion compared to 27 of the prior year, which was 3.8 in the year before that. Shares outstanding, as I said, they're buying back shares. Now this does include the stock split here, so obviously it doesn't handle it too well, but we can see the general trend over the last few years is that they are buying back shares. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. And I'll say right off the bat, it's $40 a share. Discounted free cash flow valuations do not like Nvidia, because normally were trading at such a high multiple. Free cash flow ratio, we have 440 and 407 of the priors. But let's have a look at the sort of more bullish case of what it's been doing recently and see if it's a buy. So revenue growth rate, we're expecting 163 and 210 billion in the next year based on the averages. Let's see what analysts are saying. Are they more or less bullish? We'll go on the high estimates for Nvidia 130 and 270. So they are still expecting potential big 50% growths. So, you know, let's do it. Let's go the bull case here for Nvidia. Now brings it to $73 a share. Net income margins, they have been growing. We'll go with 55, $110 a share. And net income to free cash flow, we'll take the most recent number of 88%. Puts it fairly valued. Quite interesting, actually. That is pretty interesting. But that is on the more bullish case for a discounted free cash flow model. But it shows Nvidia previously, this model has not liked the stock at all. But it is showing that these numbers, if they continue what they're doing, it is fairly valued. Before we continue, please give a like on the video and check out my Patreon if you're interested in buying this sheet. Links are in the description. Dividend discount model, we won't really look at this because the dividend is too small, puts it at $5 a share. But anyway, Ben Graham formula for intrinsic value. This was a way of valuing stocks created by the godfather of value investing himself, Ben Graham. Looks at earnings per share, PE of a non-growth company, the AAA bond yield. Currently, it is still 4.95%. And analysts are saying that Nvidia will be growing at a fast rate. But they are going to say that in the current year 120%, in the next year 45%. So we'll look at 45 first and see where that puts us. 45, $100 a share. So to be at fairly valued, it would need to be at around about 70% growth. But yeah, bit overvalued by Ben Graham's model, but it's in the same ballpark at least, which is pretty crazy. Last year or a few years ago, Nvidia would not have been. So finally, we will look at the comparable company model. This is a way of valuing companies, looking at similar companies, I've said the word companies too many times there, which are in similar industry sizes, and the metrics we're looking at is revenue growth rate, EBITDA, net income, profit margin, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, PE, and also forward PE, and then we get some averages here. So we'll look at some direct competitors here firstly. We'll type in AMD, we'll go with Intel, and we'll go with Qualcomm, can't spell, Qualcomm. So, straight off the bat, Nvidia is the largest company by quite a bit, almost 10 times the size of everything else. Revenue, highest revenue, 126. Intel is, half the size in terms of revenue. Growth rate, despite this massive increase, biggest growth rate, 50%. Only AMD is close. Profit margins, Qualcomm, very good profit margins of 26, yet Nvidia is 55. Price to sales is the highest, price to book it is the highest, but PEG, which is Peter Lynch's price to earnings growth, 1.12. Under 1 is undervalued. They're all pretty close. AMD is definitely under 1, so we probably should have a look at that. Then we have EV to revenue, EV to EBITDA, PE, forward PE. Unfortunately, Intel does not have a PE, so we can't use that one, but Nvidia is less than AMD, which is interesting. Let's see what the average is, because it doesn't really work if we break it. Average 300, but that is all over the place here because that forward P. So now we'll look at AMD kind of directly. Does look like a buy compared to AMD. $160 a share is where it puts it. So quite interesting. And finally, what we'll do here is just compare against. It is the biggest. We'll look at the second biggest, the third biggest, and the fourth biggest in the S&P 500 and see what that gives us here. We'll just go through this quickly because the video is getting a touch long. But it is the largest, it has the lowest revenue, fastest growth, biggest margins, lower PEG, interestingly, but I need to have a look at this forward P ratio. I don't think this is quite working expected, but not a buy, basically, according to this. But I think these models have said it's consistently been not a buy since the start, since I've been doing this channel, and the stock is up, 2,000%. So Nvidia is breaking all the rules. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check out my Patreon. And I'll catch you guys next time.